if you think of it, if you think of most asset prices versus this debasement, the S&P is doing about 8% a year since 2012, which basically just keeps your head above water. The Nasdaq's done about 17%, but Bitcoin's been doing 150%. And when you look at Nasdaq versus Bitcoin, the Nasdaq is down 99.97%. So it does do very good for your purchasing power, but this debasement is a real issue because most things just don't keep up with the debasement. So you're right, we're not going to have a massive debt blow up. What we're going to have is this ongoing bleeding of all of our purchasing power.
The gradual debasement of currency is steadily eroding our purchasing power, making it increasingly difficult to maintain financial stability, according to Raoul Pal, CEO of Rio Vision. He emphasized that this currency debasement is a significant issue because most assets struggle to keep pace with it. Instead of facing a sudden financial collapse, we're experiencing a slow, ongoing decline in purchasing power. This continuous erosion means that even without an immediate crisis, people are gradually losing their ability to afford goods and services as their money loses value over time. Stay tuned until the end of the video, where Raoul Pal reveals how the government could potentially disrupt the crypto market in alarming ways. Before we continue with the rest of the video, do check out daily 5-minute crypto newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now.
ETFs are driven by two: net inflows, or people known as arbitrageurs who are, arbitraging the futures market. So we don't know what that flow was. So they would sell the futures, which trade at a premium, and then buy the ETF. We don't know what that flow was, but let's assume it's net inflows because Binance saw record inflows yesterday as well. So what we're seeing is people, I think, because of the education that you've been doing, I've been doing, Michael Saylor's been doing, everybody's been doing, people are starting to understand the game. And even Larry Fink has been explaining the game. The game is the erosion of your purchasing power, not via traditional CPI inflation, but via this more pernicious debasement idea. And I think people are understanding and have been educated that this is a volatile asset class. And, as I started at the beginning of the show, is if we do get sell-offs, people are starting to realize that's when I buy. That same strategy worked incredibly well in the Nasdaq over the years as well. You've got a big secular trend, any wobbles, generally a buying opportunity.
Solana. What do you think?
Solana is cheap, fast, and there's a lot of innovation coming. And we're seeing lots of nice, easy applications for people to use. So, what drives a blockchain use? Well, nice applications, easy use, and cheapness. So it's really, really blowing out all the metrics versus other chains right now, hence why its price outperforms both Bitcoin and Ethereum. So it's been definitely the big breakout of this cycle, and I think it continues because it's getting a lot of traction. It's just a very easy to use chain that's very fast, and a lot of the applications are just very user-friendly. I think Solana grows massively and closes the gap massively with Ethereum. Different chains are used for different things. Ethereum is securer, is probably the chosen one for the finance industry to build on top of, whether it's layer 2s or whatever, because it's very secure, very well battle-tested, and very respected and still innovative. Solana seems like it's more for retail application and fast-moving applications. Even maybe crypto exchanges can build on the new Firedancer part of it because it's super fast. So I think, to extract away for people watching this, I don't really understand this. It's really simple. Bitcoin, Ethereum, Solana, they're all just decentralized businesses selling block space on their blockchain. And different block spaces have different attributes, and they're used for different cases. So Bitcoin is the single most secure. So right now, its main use case is just Bitcoin itself. And it's perfect in that way. Ethereum, DeFi has really been the big thing. And obviously NFTs were very big, but that's also gone to Solana. So valuable transactions, if banks are going to transfer hundreds of gazillions of dollars between each other, Ethereum is likely the chain of choice. Solana, for lots of rapid transactions, it's the right choice. We will see other things, whether it's Sui, which is the Mistin Labs one, or Avalanche or others, for gaming or for other applications like converting the old Web 2 social media into Web 3 or music. They will all find different blockchains that better suit their purpose. When you invest in the crypto asset class, you expect volatility. If I go back over all the years I've invested, most years you get 2, 3, or even 4 30% drawdowns. This one in Bitcoin has been 27%. It's kind of within the range of normality. And what you need to ask yourself is the main drivers of crypto are the business cycle, i.e. where are we with the economy? Well, we're starting to pick up slowly, inflation's coming down, rates are going to come down, liquidity is going to come in, and so therefore that's usually a very good time for crypto. So the tailwind is behind you. And the other thing, are people adopting the technology? Are things being built on it? And that's ongoing too. So when you see a news event like the last few days, driven by macro factors, you tend to think they're likely to be short term. Now, if the business cycle was getting old and the economy was starting to feel a bit more fragile, then yes, you might be worried about it. But this is early in the cycle, and generally you have to expect the volatility. And how I've always dealt with it is a Jedi mind trick, which is you look forward to it. When it happens, you can buy more, and you get to compound your returns much better than anybody else who just does nothing or tries to trade around it. So you should be thinking of these sell-offs as a gift, as, oh wow, if I can find a bit more cash, I can put it into the market. And you tend to do really well over the cycle by doing that strategy. But even more so, it's generally not the change of interest rates. Nobody really cares if your rate goes from 10 basis points to 25 basis points or whatever, right? What it actually was the move in the yen, because you have to pay back you're borrowing yen. When the yen starts moving a lot, then that starts concerning you. The yen went up a lot. So suddenly the amount of yen you've borrowed has gone up in dollar terms. So what happens is everybody reduces risk. And that was the real thing, is the Bank of Japan started intervening in the currency market because their currency was too weak. And they started selling dollars and buying their own currency. That's what everybody borrowing yen went, oh my God, now suddenly, yes, I'm getting a cheap pickup in borrow, but bloody dollar yen is moving 2% a day every single day, and I'm losing a lot of money. And what happens is a risk manager comes along at a bank or a hedge fund and goes, you need to close your positions or reduce your risk. And that's really what the last 4 days were all about, was the risk manager tapping somebody on the shoulder saying, listen, you're losing money on this side, you need to start reducing risk. And that's why everything gets hit, from crypto to NASDAQ to mining stocks to oil to anything, any risk at all. But these tend to be very short-lived because, once the market resettles, they get used to the change, people have been washed out of positions, it then kind of settles back to normalcy. And these, I call them macro spasms, they don't usually last very long. Could it last a week? Could it last 2 or 3? That's possible. 2016 saw very similar. The dollar had been very high. The world economy was super slow. World trade had slowed down because the dollar was so strong. And the Japanese came in and intervened in their currency. All the markets blew up. Exactly the same mechanism. But what happened after that was the central bank started stimulating, particularly the Chinese, because they've been waiting for this moment to do so. The Europeans last time around and the UK last time around. This time, I think it's going to be the Chinese who are going to stimulate. And why they get to stimulate is they couldn't do much cutting of interest rates or stimulating of monetary policy because their currency was too weak and they didn't want to lose control of it. But now the dollar has weakened, they're able to do more. So I think really it's probably a net positive. Just give it a few weeks and it's probably very positive. Firstly, it depends when these events happen. If the economy is rolling over after you've had a strong period, inflation has been rising, the Fed are raising rates. If it happens then, it can risk turning into something bigger. When you're the opposite, which is the business cycle is just turning up now, the Fed are cutting rates, the probability of this being a bigger event is significantly lower. So from that probability, less so. The other thing is something happened in 2008 that has stopped a lot of this. In 2008, the central banks discovered the money printer. And the money printer, and you and I have talked about it on this show before, essentially is debasing the currency by printing more currency. Now, it's dressed up in a nice term called liquidity these days. It used to be quantitative easing, but they find different ways of doing it. When they print more currency, it makes the value of the purchasing power of that currency go down versus scarce assets. So it makes assets go up. So now every 4 years, in fact, that we've come close to something that could be nastier, they've started printing money. And it's not just the US, it's everybody, all the main central banks. And that has kept a bottom under markets. Even in 2022 was a bit trickier because we had inflation. So it was hard to print money. But eventually when it got to it, when the S&P was down about 30%, they kind of went enough's enough. And they started printing money again. So I don't think there is a lot to fear. In fact, I would be so outrageous to claim the probability of a down 50% market is now miles smaller than it was when you and I grew up, when it was a common occurrence that we would see it. We won't see this again because of the money printer.
Okay.
Doesn't mean it's a risk-free world, obviously, because when they print money, they're debasing your savings by 8% a year to start with. But if you think of that 8% cost of that debasement, that's like the central bank's buying a put option on the whole system, and it's costing you 8% premium a year. Put it that way, it's not the worst thing in the world, but it's never great. I think all of these big blockchains will be worth multiple trillions of dollars because these are not single applications, they're entire networks of which you can build entire other businesses upon. These are immensely valuable things, but the applications haven't yet been built on it. So yeah, I think you're dead right. You know, this cycle is not where these things are going. I think this space goes from 2 trillion today to 100 trillion by 2032, 2034. Therefore, as an investor, that's the thing to keep in mind. How do I stay in this trade for as long as possible and compound what is the largest? You know, if I go back to anybody and say, would you have bought the NASDAQ in 1990? Everyone would, hell yes. Well, here you've got it, 1990, not 99, 1990. You go, hell yes. Well, that's where we are now, somewhere in the mid-90s of the NASDAQ.
Trump proposed a national Bitcoin stockpile, sort of like a reserve fund for Bitcoin. What is your take on this, and how would it impact the crypto market? This is Lucille from Kentucky.
So I actually think it's a bit of a red herring because the US dollar is the world's reserve currency. The US doesn't need to hold other assets in reserve. Yes, it's got gold, but that was a legacy from leaving the gold standard. Other countries have to have reserves to support their own currencies, so they don't need it. Now, would they do it? I think it sounds flashy. For what reason, I don't really know. But let's assume that they do. Let's say I'm wrong and they do build something. It's kind of a weird world because, yes, obviously it's good for the crypto market because there's yet another buyer. But it's also weird because Bitcoin was set up to try and replace the government's control over money. And now you're inserting the government as one of the largest buyers of private money. I don't really like that, actually. But, but it's probably net positive for the crypto price. Now, maybe it pushes private use of money away from Bitcoin if that were the case. Because if the government can manipulate it, they could dump it onto the market, they can buy more, and before you know it, they're using it like they are interest rates in controlling regular money, and we don't want that.
Raoul Pal warns that the concept of a U.S. national Bitcoin reserve, while attention-grabbing, could have perilous consequences. He argues that the government doesn't need to hold Bitcoin since the U.S. dollar already holds a dominant position in global finance. However, if the government proceeds with this plan, it could disrupt the crypto market in troubling ways. Bitcoin was created to challenge government control over money, but if the U.S. becomes one of the largest Bitcoin holders, it might use this position to manipulate Bitcoin and tighten its control over the financial system. This outcome could undermine the very purpose of Bitcoin, which was designed to prevent government interference and maintain a decentralized currency. For more Daily Dose crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.